So it's been a while since I've updated our workshop. I didn't update it in well, I guess I updated it for live events in 2020, but I haven't updated it for my like online class. So I wanted to get you an update to our workshop here on the site, just so you can kind of revert back to it. It's our kind of quick run through of the info. So it's not the same as our in-person, and you certainly can't ask as many questions or go through it like you would if it was live, but hopefully it helps. Or if you haven't been to one of our workshops, or if you haven't sat down with us, you have some kind of a resource. So hopefully you guys like it. Hopefully it's helpful. If you need anything at all, reach out. We're here to help in any way we can. And our staff is all military spouses, veterans, and we exist to serve and answer questions that you guys have related to home ownership and using the VA loan. All right, let's get into it. All right, guys, here we go. So yeah, VA Homebuying 101. This is kind of like my flagship seminar workshop class that I've given forever, that kind of doesn't really change too much, but year to year, some of the figures change, some of the loan limits change, some of the data changes. So hopefully it's useful to you. If you want to share it, gosh, it's all just out there and meant to be helpful if at all possible. So let's just jam in and start working on this stuff. Usually if I was working with a class live, I'd be asking kind of like what their goals were and what they wanted to do, so I can kind of drive it in that direction. But I'm going to try to keep it super general, and then you can reach out to us through the contact on the website. Just if you have specific questions. Again, everybody's always fearful that somebody's going to jump all over them and try to get them to buy a house right now. And that's not the case. We're just here to kind of answer any questions you have and help in any way that we can. So first things first, let's go over the agenda real quick. And there's a rhyme and a reason to this. It goes through a process a little bit, because the VA loan isn't really anything special. It's just a loan, right? So number one is you have to understand kind of the basics of home loans. So I'm going to show you the basics of just kind of how home loans work in general. Then we'll overlay the VA home loan on that, because if you have a good understanding of how loans work, you'll understand how the VA home loan works better. So we'll go through some VA home loan specifics. And then it's really important from my standpoint to give you something like actually tactful and tactical and useful. And so what we'll do is we'll take a sample scenario. I'll take a Marine Corps sergeant, married, look at BAH, look at income, we'll look at debt, we'll look at assets, we'll look at all that stuff, and we'll build out like a sample pre-approval. And hopefully what that allows you to do is it allows you to kind of take your scenario and kind of overlay that, and you get a real good understanding at least of how things work. Then just to kind of go over some of the unique characteristics of VA, I usually, again, we'll do a Q&A or a FAQ or we'll poll the audience in terms of like who thinks what about these answers in person. But since we're doing this on kind of a recorded format, I'll just kind of run through the unique characteristics and the frequently asked questions. And then really briefly at the end, I'll go through the purchase process. Like, okay, not necessarily from a loan standpoint, but from okay, I'm ready to buy a house standpoint. This is how this works. So the idea of this course, or the idea of this recording, is to give you a really, really good idea of how things work. It'll just give you a baseline solid set of information. The next step after that is to take the information and develop it into a plan. The problem is people start planning once they've found a house that they like, and it's like, it's way late in the game. So I don't care if you're buying now or 5 years from now. If you put a plan together, you'll be in the best possible spot at that time. And that's what we specialize in my office. So if you want to contact us to put a plan together, that's what we do all day long. And again, it doesn't matter if you're buying here or somewhere else. It doesn't matter now or later. Again, the reason why I do this is I got out of the Marine Corps with, very little, and learned how to buy homes, and learned how to budget, and I learned how to run a business. And those things were like game changers for me. So that's why I'm 100% committed to helping you in any way that I can. So develop your own personalized plan. And then it's just a matter of executing the plan. No emotion to it. It's just like, It's very tactical if you know the tactics. So let's jump into the tactics. But first, I'll kind of tell you a little bit of my background. So I was in the Marine Corps from 99 to 2004. Just did one 5-year stint. When I got out of the Marine Corps, I started the Lehman Group. I left the Marine Corps like $50 in my pocket, and I kind of fell into VA home loans. Over the next, I don't know. I mean, now it's 2020, pushing 2021. Gosh, I mean, we've come a really long way due to, again, a couple key things: home ownership, budgeting, personal finance, investing, entrepreneurship, starting a business, even if it's like a side hustle type thing. I mean, it's so vital. Budgeting is key. All that stuff is key. Anyway, so I got out in 2004. I kind of started the Lehman Group at that point. We've grown from there. I wrote a book called the VA Home Loan Field Manual. It's a really ugly looking book to people that don't know what a field manual is. If you know what a field manual is, you'll recognize it right away. And that's on our site too. And I'll send you a free one. And I'll if you message me, whenever you're done watching this, I'll send you a copy of it too. You could just message me through the site or whatever, or email me, and I'll send you a copy of the book in PDF. And that'll help maybe like be a reference point to some of the stuff that I'm going over today. Currently, as of it's December 2020, man, 2020 has been a hell of a year. 2020, I'm the director of VA lending at SunWest Mortgage Company. So that's where I'm at currently in terms of my day-to-day. And my team at the Lehman Group helps military families every day kind of put plans together and buy homes. Again, my office and my team is all some kind of military adjacent, either spouses or family members or veterans themselves or whatever. And I'm a homeowner, obviously. And when I got out, again, we had very little. We bought our first house shortly after. We rolled that into another and another and another. So that's me probably, I don't know, somewhere around 2004. And then that's me, albeit beardless. This was probably a couple years back from now even. Now we got a big black truck. I got rid of that silly Jaguar right there. But that's our house in Carlsbad, and that's on a VA loan. So it's massively beneficial. And that reminds me too, I mean, like, you don't have to go out and buy your dream home right out the gate. But when you're paying BAH and you're paying, when you're getting BAH and you're paying it right out, you don't really have the foot in the door. The market's running away from you. Whereas if you can make it work, and get your foot in the door, at least that money is going towards something. And if it makes sense at some point, you can sell that, take the equity, carry it forward to somewhere you actually want to be, whether that's here or somewhere back home or wherever you're going. All right. So this is just the groundwork on how home loans work in general. So it's not VA specific, just kind of get the concepts. There are really only 3 major characteristics that any bank are going to look at when they look at you as a borrower or you as a family who's borrowing for a house. It's going to be your credit, your income, and your assets. So we'll go over CIA, credit, income, assets. So we'll go over those 3 things. What that turns into are 2 major lending concepts that I'll explain to you. And those concepts are debt to income ratio, that's a biggie, and loan to value ratio, which is kind of a biggie, but loan to value explains how VA works. So we'll get into that. Let's talk about credit. So credit basically is the way that the banks try to predict what you're going to do in the future based on what you've done in the past. If I lend you $20 and you don't pay me back, you have bad credit with me, right? So credit is not an inherently bad thing if you manage it well. Credit account history is reported to 3 bureaus: Experian, TransUnion, Equifax. What some people don't know is that Experian, Equifax, and TransUnion, they don't create the score. So when you say I've got a 700 FICO score, that's not created by Experian, Equifax, and TransUnion. That is Experian, Equifax, and TransUnion. They just hold data. And then a credit company will pull that data, run it through an algorithm. So I'm sure some of you out there use Credit Karma. I'm sure some of you have used like freecreditreport.com. You pull your credit, it's like a 780. And then a lender pulls in and it's like a 750. And you're like, what the heck? My credit score dropped 30 points. It didn't drop 30 points. Credit Karma just uses a different algorithm. And the reason why their score is higher is because A, they're not lending you anything. And B, Credit Karma has an incentive to show your credit score higher, because if you think your credit score is higher, you're more likely to go get another credit card, and that credit card company is going to pay Credit Karma, marketing dollars for the connection. So make sure when you're doing your plans, you're pulling your credit from where you're going to borrow from. Because if we're lending you 500 grand and Credit Karma is not lending you anything, their score is going to be higher. So anyways, that's credit. From a lending standpoint, the lender's only going to be looking at two things. They're going to look at the actual FICO score that runs from like 450 to like, I don't know, 8 something. That's the numerical representation of how you're doing. The higher the score, the better, obviously. Maybe not obviously, but the higher the score, the better. Monthly debt is the other thing. We really don't care as much about your $30,000 balance on your car. We care about the $500 a month payment, because what we're trying to do as lenders is figure out, okay, how much can you spend per month? And so what does your monthly income have to be, your monthly debt, because your mortgage payment is a monthly payment. So we don't really care about how much you owe. It's more about how much you pay per month. So when we talk about monthly debt, that's what we're talking about in the context of credit and lending. Income is the key factor in the amount you qualify for. Obviously, if you've got more monthly income, you'll potentially have more income that can go towards a house payment. Therefore, it kind of is the determining factor in how much you can borrow. Income has to have a history, and I'll revert back to this in a second and give you some key points. You have to have a history. You have to have a history in a similar or the same industry. You don't have to be on the job for 2 years. It has to be stable and likely to continue. So I'll give you a couple examples. Military retirement, totally good. Military GI Bill, no bueno, doesn't work. It doesn't work because it requires that you go to school to get it, and it's temporary. Military disability is permanent, right? So you're going to get disability. It's not only you can not only use it, you can use it and it's tax-free. In terms of employment, if you're military and you're getting, okay, so in order to use military income, you have to have 1 year left on your LES. You have to have 1 year left on your LES until your EAS, or if you're an officer and you don't have a true EAS, you have to show that you've got at least 1 year left on your contract. If you don't have a year left on your contract, you can write a letter that says you intend to re-enlist, and then your command has to write a letter saying you're eligible to re-enlist. Like you can't be getting kicked out for being a dummy or something. You can't be you're not picking up rank. So you have to be able to re-enlist from your command. You have to write a letter saying you intend to re-enlist. Now, what if you change your mind? What if you buy a house saying you intend to re-enlist, and then you change your mind and you don't want to re-enlist anymore? Well, is what it is, right? I mean, there's nobody that can say you have to stay in. I'm not telling you to do that. I'm just telling you that if you intend to re-enlist and then you end up not re-enlisting, I mean, it is what it is. Like I said, there's nobody that's going to go break down your door and make you re-enlist because you bought a house saying you were. Okay. It has to be documented. So any under the table work, any side business, side hustling, that stuff doesn't, where it has to be either on a tax return or it has to be on a pay stub, or it has to be documented. It has to, the existence and the amount have to be documented. All right. Income is a big question. So if you have any questions about income, just drop me an email or something like that, and we could talk specifically about your income situation. If you're working with a bank and they're having trouble with your income, a lot of times there's a solve for it. They're just not, most banks just aren't really good at putting income structures together. So we can help you with that. All right. Assets used for down payment, closing costs, and reserves. Assets are basically just cash and that kind of thing. Generally, when we're talking about assets, we're not talking about your car. We're not talking about land that you own or something. We're talking about actual liquid assets. VA, we could talk about VA and assets and the need for assets, but just don't even worry about it. For now, all you need to know is that what assets are. All right. So this is a biggie. Debt to income is the relationship between your gross monthly income and your monthly obligations. And it's the key. It's not even a key. It's the key factor determining how much you can borrow. So here's the equation. I don't even know if you guys can probably see this mouse. Your prospective house payment, not what you're paying now, what you will be hypothetically paying if you buy a house. plus your monthly debt has to be under a certain percentage of your gross income. So if this whole thing is your income, your house plus your debt divided into your income is your debt to income ratio. And that's going to be the factor. And I'll go through that when we get into kind of VA loans specifically. But in essence, the bank requires that your house payment and your debt be under a certain percentage of your gross income. So debt to income, let's put some numbers to it. Let's say you make, I mean, because I'm a dummy and I need a calculator for 2 + 2. Let's say your income is 10 grand, just to make the math really easy. Let's say between you and your wife or you and your husband, you make 10,000 a month gross income. Let's say your house payment is $2,500 with taxes and insurance and everything, and your debt is 500. So you've got a total between your house payment and your debt of 3,000. And you've got a total of 10,000 income. Your debt to income ratio is 30%. 3,000 divided into 10,000 is 30%. So FHA, conventional, VA, they'll all have guidelines as to the max debt to income percentage that you can go up to. And as long as you stay under that, you'll be qualified basically from an income standpoint, as long as everything else works out. So that's a big one. You'll get it by the end of this because we'll keep reiterating this. Similar, loan to value represents how much money you owe on a home in relation to the home's value. The lower the loan to value, the lower the bank's risk. So think about this. If you have a house worth $1 million and you owe $200,000, there's very low risk for the bank. That's called loan to value. 200,000 out of $1 million, that'd be a 20% loan to value. Because if you didn't make your payment on that $200,000, obviously the bank could pretty easily sell that house and get their money back. And you're probably pretty likely not to abandon that house and give it back to the bank if you've got all that equity in it. So that's a risk factor. But if you owe 200,000 and the house is worth 180,000, or let's just make the math easy again. If you owe 200,000 and the house is worth 200,000, that's 100% loan to value. If you were to stop making payments, the bank would be kind of stuck. They would lose money. And so that's loan to value. The higher the loan to value, the higher the risk to the bank. And whenever you hear risk from a bank standpoint, that means generally more risk, higher interest rates, or more risk. They just won't do it. So just don't worry too much. Just understand the loan to value element. So that is pretty much all you got to know about the basics of lending. And just to kind of reiterate, credit, income, assets is what the bank's looking at for you. Debt to income will determine how much you can borrow. Loan to value is a determinant of risk, and I'll show you how VA kind of handles that. All right, so section 2. Now let's talk about the VA loan specifically. So now that you kind of get lending concepts, let's talk about the VA loan itself. Number 1, the VA loan is not provided directly from the VA. The VA doesn't do lending. The VA just provides guarantees for bank loans. So Chase, Wells Fargo, Navy Fed, our bank, SunWest, US Bank, whoever does VA loans, what is really happening is the bank is doing the actual loan. You're applying for the loan from a bank. The lender supplies the loans, funds the loan. And then what happens is the VA just guarantees the loans. And the VA guarantees them on behalf of eligible veterans. So we'll talk about eligibility. Now, prior to 2020, the guarantee went up to the county loan limit where the property was located. After January 1st, 2020, that changed. And I'll describe kind of what happened with that in a little bit. Kind of. I mean, it's a little bit in the weeds, but just remember eligible veterans and up to the county loan limit. But the VA does a guarantee for banks. The bank does the actual lending. So you're actually applying with the bank. The VA is just given a guarantee to the bank. And this will make sense in a little bit too. So let's talk about eligibility. The way that you determine eligibility is you pull what's called a certificate of eligibility. That's really easy to do. We can pull it with like your social, your year of birth, and about 2 minutes because we have an online system where we could just connect with VA. So again, if you want to pull your certificate of eligibility, just go back to the contact form and just like let us know that you want us to pull it for you when you're done, or email us or whatever you want to do. But to kind of get an idea of who is eligible, if you're 90 days active duty during wartime, which is like anytime post 9/11, you're eligible. If it's during peacetime, it's 181 days active duty. If you're a reservist, you need to be a reservist for 6 years. Or let's say you're a reservist and you get called up for active duty for at least 90 days during wartime, then that will cause you to be eligible. And then obviously the last thing is your benefit, your VA home loan benefit doesn't automatically transfer to your spouse. It only transfers to your spouse if you, well, I don't want to make this personal and talk about you guys in particular. Okay. If one was to get killed in service or was to die as a result of a service-connected disability, let's say somebody was in like Vietnam and they had disability for Agent Orange, and then something happened to them and they passed away as a result of that disability, or there's some missing in action, prison award type stuff, then your eligibility can transfer, but it doesn't happen automatically. It's generally for the service member only. And it's weird. I just got a call the other day and they were talking about, I was always thinking like, Army, Marine Corps, Coast Guard, even Navy, Air Force. There's also some like medical corps people or something that are considered a uniform service, I guess, that get it too. So that's a trip, but I haven't run into it, but I saw a recent example of that. But anyways, all right, for most of you, I would think 90 days active duty during wartime would be the thing that makes you eligible. All right. Now, who can use the VA loan? The veteran the veteran themselves. And when I say veteran, I don't know what the right term is for active duty or veteran. I always have to like make that, like, if you're in the military, you can use it. And if you're a veteran, you can use it. The veteran and the spouse can go on a loan together. So you and your spouse can go on, whether you're the spouse or the veteran, you guys can do a VA loan together. A veteran and another eligible veteran, called dual eligibility, what you can do is, like, let's say a couple corporals want to get together and buy a duplex or something. They can do that. Or if they want to buy a house, whatever the situation is, you can have two eligible veterans. A veteran and a non-veteran is very atypical. So a veteran and a non-veteran would be one of these situations where, like, it's a civil, like, it's someone who's been together forever, they're fiancés, and it's just a well-documented relationship. It's like almost a spouse or someone who's been living together forever. And there's it's very atypical. And the problem with that one is it has to go to the VA for prior approval. It has to go to the VA. The VA has to approve it first. And if it's a non-veteran, you have to put a down payment. So generally speaking, you have to put like a 12.5% down payment is, I think, what it is. So it's not super typical. And widowed spouse we talked about. All right, so the loan limits. So we'd be having a very different discussion if we were still 2019 and prior. Prior to 2020, the VA limited 100% financing, meaning zero down. You could put zero down only up to the conforming loan limits. Anything above that, you had to put a down payment, not a full down payment, but you had to put 25% of the difference on top of that. And I'll get to what changed. In 2020, the loan limits are as follows: San Diego 701.5, Orange County 765.6, Riverside County is 510.400. And if you look at that 510.400 with the little asterisk next to it, that's the lowest it goes. So if you're looking at buying for like a couple $100,000 in Tennessee or something like that, as long as you're under 510.400, that was no problem. Like 510.400 is the lowest it goes. So that's good. In 2021, the VA loan limits haven't come out quite yet. They're about to come out. They're going to come out like any day. Conforming loan limits have come out. And so I would guess San Diego goes to around 750 and Riverside goes to around 550, something like that, 540 something. I would guess 548 maybe. I would guess Orange County probably pushes 800. But those loan limits are coming out, and I can link to the county loan limits below this training, or you can email me or whatnot, just so when it does come 2020, I don't have to record this thing over and over and over. I'll put some loan limits down under this video. Yeah. But okay, so it's a little bit irrelevant now because after January 1st, 2020, there was a House Resolution Bill 299. It's called the Blue Water Navy Vietnam Veterans Act. And what that says is if you have full eligibility, meaning if you don't have a house with a VA loan on it now, There is no VA loan limit. You still have to qualify because eligibility just says you can do it. Qualifying, you still have to qualify for the loan. And that's a factor of debt to income and what we were talking about, debt to income and credit and income and assets. But if you have full eligibility, there is no VA loan limit. A couple months ago, we did a loan for a physician. He was a Navy, well, my friend was a Navy nurse. She got out and became what did she become? Like an anesthesiologist. Yep. She married like a brain surgeon, and these guys are doing well, as you'd imagine. So they qualify for a lot. They ended up buying a $2.3 million house with zero down on a VA loan at like 2.75% interest. I'm not saying that's the vast majority of our clients. Vast majority of our clients are young families buying their first place or second place, or, buying for much less than that. But just to give you an example, there's no VA loan limit after January 1st, 2020. Again, you still have to qualify. If you have a loan now and you want to buy another home, then you're subject to the loan limit. So then you'll have some remaining eligibility potentially. But we'll get into that. If I am eligible for VA, is that the best way to go? We get that question all the time. Hey, I'm eligible for VA, but I heard VA is tough. I heard VA is this. I heard VA is that. Is VA the best option? Generally speaking, there's only really 3 loan types. All of the rest are kind of, are categories of that or extensions of that, or kind of really similar to that. So generally speaking, VA will be better than conventional. Conventional will be better than FHA, and FHA will be better than renting. So if you can go VA, it's a massively beneficial loan. And so to drive that home, or to kind of explain that, I'm not going to drive you crazy talking about FHA because it's pointless. But what I'll do is I'll give you kind of the rundown between VA and conventional. And when I say it's generally better, it's like 95% of the time. It's not always. And I'll give you some exceptions too. All right. First things first, with VA loan is typically about 1/4 to 0.5% less in rate than conventional at similar terms. So the VA from a rate standpoint is generally cheaper than the conventional loan. Credit is less of a factor. So if you're sitting there saying, oh man, my credit slipped down to a 670, 680, VA doesn't really care much. So you should always get that plan together and pull your actual credit, see where you're at. It may make sense to kind of make some steps to increase it a little bit and, for other reasons, but conventional loans, if your credit is above 740, you're good. As you start going down 720, 700, 680, you start getting really hammered on conventional loans. With VA, it's really super similar. It's you don't take a massive hit for credit. The VA's job is different. The VA is there to help veterans become homeowners. They're not worried as much about investment returns or about that level of risk. And as you'll see, they have the guarantee from the VA when the bank does them. So if you have imperfect credit, VA is a good way to go because it just does not impact you as much as conventional would. From an income standpoint, if you remember debt to income ratio, remember your house plus your debt has to be under X% of your gross income. Conventional kind of caps you in the 45 to 50 range. VA caps you at like the 60-ish range. And I should say as a caveat, because somebody's going to call me on it, the VA loan is not a DTI loan per se. It's called a residual income loan in the sense that what they want to know is after you pay all your bills, you got some cash left over. That being said, when we do qualifications, generally speaking, where we will get a automated approval, which makes things really easy, is at 60% or less. So don't at me. From this slide, just take that the VA allows for a little bit more flexibility. And what I mean by that is, let's say there's a husband and a wife and they want to go on a loan together, and the husband is the veteran, so he's got to go on, but the wife's credit isn't as good and they don't have an income. Well, you could take the wife off, and as long as you still qualify with the husband's income, you're totally good. The wife can still go on title. She could still be an owner of the property. They can go on the ownership together, but we can take the husband off, and in that way, we have more flexibility. We can go all the way up to 60%. So if his income works there, we're good to go. So it provides a little bit more flexibility. Do you have to go up to 60% of your income? Of course not. Absolutely not. That's just the cap for an automated approval. All right. I am going to explain to you kind of how the VA loan works in a nutshell. A lot of people think that you need 20% down. They've heard, hey, 20% down on a conventional loan. We get people coming in all the time that think they had to save 20% to do a conventional loan. In reality, banks do not require, conventional lenders do not require 20% down. You can do as little as 3, 5, but the bank does require coverage up to 20%. Remember we talked about loan to value, they do not want to lend unless they're covered at an 80% loan to value or have some other arrangement. So putting 20% down is one option to give them that safety net, that 20% safety net. The other option is if you don't have 20%, the conventional lenders will allow you to take out an insurance premium for the difference that basically says if you don't pay and they take a loss, that insurance premium will pay the bank and cover their losses. So if you don't have 20% down, you have mortgage insurance. Mortgage insurance is an extra expense, couple hundred bucks on top of your payment. So mortgage insurance is an added expense. Now, how does VA work? What VA does is, remember, I said that the VA guarantees up to 25% of the loan. The VA does a guarantee. So they don't give you the money, but they tell the bank, look, based on this veteran's eligibility, if they don't pay, we'll cover you. So you don't need 20% down. You could do 0 down. You don't need any mortgage insurance ever because the insurance is provided by the VA basically at no monthly cost. So based on your eligibility, that's how the VA works. In a nutshell, this is the VA loan. The VA does a 25% guarantee for the bank. They cover 20%, 25%, which is more than the 20 the bank requires. And that's partially why the rates are slightly better. The risk is less because they're up to 25% covered. And that's why the bank will give you, in this example, look at that $500,000 purchase price. The bank will give you the whole $500,000 with 0 money as a down payment because the VA is doing that guarantee, and you'll need no mortgage insurance because they cover it. So this is the VA loan in a nutshell. That's kind of the benefit of the VA loan, one of the bigger benefits of the VA loan. So in summary, there's less restrictive credit. You've got lower interest rates. You don't need a down payment up to the loan limits, or now I can scratch out that up to the loan limits. If you have your VA eligible and you don't have anything used up right now, there are no loan limits. You can go up to whatever you want. There's no monthly mortgage insurance. You've got more flexible debt to income ratio. And so in most cases, if an individual qualifies and is eligible for VA, it's the best loan available. All right. So let's do a sample approval that kind of ties all this stuff together. This is kind of like if a client came in and wanted to get pre-approved. I think there's some value in showing you how it works. I am always a proponent of showing people how things work as opposed to telling people what the outcome is. It drives me crazy. Most pre-approval processes, you give your documents up to somebody, they go behind closed doors and then spit out a paper that says, hey, congrats, you're qualified for $500,000. You know, they don't know what the you don't know what the inputs were. You don't know why it's 500. You don't know what your payments are. You don't really understand any of that stuff. That kind of thing drives me insane. So I think it's valuable to kind of tie up some of these things that we're talking about through talking through a sample pre-approval. So I'm going to use, if my computer lets me, yes, this is what I just said. I'm going to use a Marine Corps sergeant. And gosh, my pay and BAH and stuff is probably off. This is probably from like 2019, but get the concept. I could update the numbers at some point. Okay. Active duty Marine. Does he have to be a Marine? In my example, yes, he does. In reality, no. Active duty Marine with dependents, 6 years time in service. He's a sergeant, $350 a month car payment, $100 minimum credit card payments. Alrighty. So this breaks down his income from DFAS with BH and BAS. Again, I'm probably off on this. This is probably like a year or so old. But total income off the LES is $62.15 a month. And then, I said $450 in debt. There was like a $350 credit card or $350 car payment and like 4 credit cards. Again, remember, the credit cards could have balances of $3,000 each, but the minimum payment is what we're looking at. So I'm using $450 a month in total expenses. Again, good Lord, you could say that it's ridiculously low. You could say we should use a high, whatever. You know, just kind of get the concept, and then you can apply whatever numbers you want. I've had people at seminars before looking at me funny when I said $450 a month. We have clients all the time with like very little debt. Anyways, okay. So your prospective home payment plus $450 in debt has to be less than 60% of the gross monthly income. So all we have to do is, in this equation, we have to solve for X. The way to do that is to work backwards. So we start with 6215 over here on the right-hand side. You know that with VA, you've got a max debt to income ratio of 60%. For your house payment and your debt together, 60% of 6215 is 3729. Next case is we got to solve for X, right? So all we've got to do is subtract the 450 debt from that 3729, and that will tell us what our max payment can be on a house. So that, what I come up with is 3279. So 3279 would be the max that this family would qualify for in terms of payment. And there's your equation, but depending on interest rates, the family would qualify for somewhere in like the 550 range at that. You know, today rates are really, really super low. 550 is probably right. Maybe today like around 600, something like that. But obviously if rates are lower, the payment's lower and you can qualify for more. But 550 this is how that would break down. Principal and interest, 2608. Taxes, 521 a month. I should say, taxes change depending on your state. I'm using California because that's where I'm at. Be careful and double check what your tax rates are. Texas has really high tax rates on their property taxes because they don't tax darn near anything else. Some areas, like I want to say Idaho and some of these other areas, have really low taxes, low property taxes. California has, 1 to 1.25% is about right. Insurance, you're basically going to call USAA or State Farm or whoever and say, hey, I'm buying a house. How much is my insurance going to be? And that's like in case the house burns down or there's damage. And then HOA, if you buy in a place with an association, I'm just kind of throwing that in there because that does go into it. But that would add up. If you add all those things up, that's $32.79 a month. And the acronym is PITI, Principal, Interest, Taxes, and Insurance, but includes HOA. So that's $550 for this family if you work those numbers in that way. Now, what if they go out and look at a property and find their dream home, but it's listed at $575? So let's say they find something that's, and this is just going to go to the use of DTI, right? If you understand the equation, house plus debt divided into income is DTI. If they found, I said, hey, your max is 550, and they go out and they say, hey, we found this place for 575, we love it. We only have two options. I'm gonna just give you the answer. We only have two options if they wanted to qualify for more here. The only things you can do is either increase income. Where did I do? There we go. Is increase income or decrease debt. To change this, all you can do is increase income. So what can we do? We can add a spouse. We can add a co-borrower. BAH and BAS are tax-free. So I can gross up that income potentially. I can pay off a couple of credit cards and show them a zero and open up some bandwidth here. If I decrease this or I increase this and they can qualify for more. Hopefully that makes sense. But knowing DTI and knowing how to manage DTI will, or at least working with somebody that does, will help a lot. Other question is, so I get questions from time to time, like say, hey, I'm getting out of the military. I know I want to go somewhere. I know I want to buy a house. How do I know how much income I need to qualify for the house I want? This equation works in multiple ways. If you knew this was like 2,500 and you knew what your debt is, you could add your house payment prospectively plus your debt, divide it by 60%, and it would tell you exactly how much income you had to make. The point of all this, without getting too deep into the weeds, is you can use this equation to solve for a bunch of stuff if you know how to. And again, any of this stuff being complex, usually we spend a good amount of time on this in our in live workshops. So I understand this is more difficult, but yeah, just shoot me a question or give me a call, and we can kind of run through it. One more important thing about this: debt to income, whether you barely qualify or you easily qualify, your rate does not get better or worse. It doesn't change anything. So let's say of this 450, he says, hey, one of those cards is already paid off. Well, as long as you still qualify with the 450, we'd probably leave it alone, because it doesn't make sense for me to run you all over town to show that paid off if it doesn't affect your ability to qualify. So a lot of times banks will find out, oh, I've got an oil well my uncle left me. It kicks me off $23 a month. And then they run you all around town showing more and more and more income, when if you qualify with the income you have, leave it alone. Leave it alone. Only add income if you need it. It'll make your life easier. All right. We are hitting the home stretch. So we're going to jump into some VA loan frequently asked questions and concepts. VA loans are for first-time buyers only, true or false? And I won't leave you waiting. That is a false. They're not for first-time buyers only. The only restriction is that the VA loan has to be used to purchase a primary residence. So you can't buy a rental property outright. You can buy a primary residence that you decide to rent out later. That's fine, but it has to make sense as your primary residence at the time that you purchase it. The definition of a primary residence is really like, does it make sense that you could occupy it within the first 60 days? Like, could you move into it? If you're out somewhere else, you'd have to, like, if you wanted to buy in California and you're in Virginia, you'd have to show orders or something. You'd have to show work. You'd have to show some ability or some feasibility that you were going to be able to own or occupy it. You can't be stationed at Pendleton and want to buy a house in, Boise without some way of justifying it. If you're getting out of the military and you got a job up there or something, it has to be a primary residence. All right. I can have 2 VA loans at once. I'll give you a couple of seconds. Can you have 2 VA loans at once? That is true. If VA entitlement remains, you can use it as long as the new property is on a primary residence. Remember, if you have a loan limit of $550,000 and you only use 200 of it because you buy a relatively small property in a relatively inexpensive duty station, you have some left over. When you move, you can use the remainder. You're not going to have unlimited eligibility like you would on the first purchase, but it's going to be limited by the loan limits at that point. But you can have more than one at a time. I can buy a fourplex. I can buy a fourplex using the VA home loan. Can I buy a fourplex using the VA home loan? For all you guys reading investment books and house hacking and that kind of thing, this be true. So true. So 1 to 4 units is considered residential. 5 units plus is considered commercial. That complicates things a lot. But 1 to 4 units is considered residential. So as long as one of the units is occupied, the property is considered owner occupied and eligible. The bonus of that is you can use rental income on the other 3 in this example properties. If you're buying a duplex, you can live in one, rent out the other, and you can qualify with the income from the rental on the other side. They'll hit you for 25% of it. They'll only give you 75% of the value of that rent, but you can use the rent to help you qualify. So if there's anybody who's kind of investment minded and is looking at a condo, you may consider buying a multi-unit, living in one, renting out the others. And now the VA loan has no limit. So if you're in Oceanside or if you're in California somewhere where a fourplex is going to run you, $1.2 million, that sounds like a lot. It does. But if you've got rental income from the other units to offset, that may be a way to control a $1.2 million asset, live in one of them and make the rent so that your cash flow is the same or better even as if you were going to buy it's cheaper per door maybe. It's a lot more competitive, but that is a possibility. You can buy a fourplex. I love the concept of house hacking. House hacking, just so you guys know, is where you use the VA loan to occupy one unit and rent out the others. Basically, it's like how a lot of people start their investment careers by occupying one unit of a multi-unit, renting out the others, and then selling that one at some point and moving on, or whatever, what have you. That's house hacking. But yes, okay, I'm going to stop droning on. This is an easy one. My non-veteran spouse's income can be used to qualify for the home we want to buy. Obviamente, that is obvious. That is true. A spouse's income can be used as long as it is stable and from acceptable source, just like any other loan. So yeah, good there. There are circumstances where my VA loan may not be the best option. I already talked about that. Yes. Planning is key, folks. So when you plan for anything, you want to kind of figure out the tools, figure out the goal, and go from there. So again, I'm going to lay it on you. I don't care if you're buying now. I don't care if you're buying 10 years from now. Well, 10 years is a little excessive. I don't care if you're buying a couple years from now. You're getting the baseline education. Put a game plan together for you. Put a game plan together for your goal. You can start working on credit now. You could start working on income now. You could start working on savings now. And a lot of times what you find is it makes more sense to buy sooner than later, just to start building that equity to get your foot in the door. So a lot of times people think they're going to buy in 3 years, and you'd be surprised at how many people are like, whoa, wait a minute. We can do it now. The payment's that's less than our rent. We should do it now. And so you don't really know that unless you get into the process. So please, please, please put a plan together. And again, VA is not always the best way to go. I mentioned if you're buying a small temporary home and want to buy one later, or if you're planning on putting 20% down anyways, and you're required to pay a funding fee. VA has what's called a funding fee that I'll go over with you real quick. It may make sense to go conventional in lieu of VA sometimes, but very few examples. So speaking of the funding fee, I'm not going to go through this like super detailed, but the VA has what's called a funding fee. A couple important things to this. You can kind of get this chart or email me for this chart, but if you have zero down payment, let me mouse it up right here. If you have zero down payment and it's your first time use, like you've never used the VA loan before, they're going to add 2.3% to your loan. So for every 100,000 you borrow, okay, if you're going to buy a house for 100,000 with zero down and it's your first time use, your loan amount is going to be, your fee is going to be 2,300, and they're going to roll it into the loan. So your loan amount is going to be 102,300. That's how the VA pays for its, program. 5% or more down, it drops to 165. 10% or more, 1.4. That difference is a difference, but it's not a massive, massive, massive difference. So a lot of times when people are buying the first time, they're not putting a bunch down. Subsequent use is when you use it the next time around, it goes to 3.6. That's chunky. That's when you really want to consider potentially putting 5% down to drop that fee to 1.65. Now, the one thing is really important for anybody that's like getting out at any time. Well, you're all getting out at some time, or you're already out. Service-connected disability waives the funding fee forever. So this becomes zero. All these become zero. When that house that you saw in Carlsbad that we bought, I had service-connected disability. I would have paid something like $30,000 in additional fees, and I paid nothing because I have a compensatory. Is that a word? I'm getting a VA check. You have to have, okay, so here's the caveat. You have to have 10% or more, kinda. The real answer is you have to be getting a check. You have to be getting a service-connected disability check. It can't be a 0% disabled unless it's a 0% disabled getting a check. And again, I can pull your certificate of eligibility and it'll say all this stuff. So if anybody wants to pull their certificate of eligibility and see if they've got their funding fee waived, I can do that too. It's super simple to do. Just message us or whatever, drop in the contact us box on the site. So yeah, disability waives the funding fee. So if you, one last thing about that. If you are getting out and you want to buy a house and you apply for service-connected disability, then you buy a house, but the disability isn't approved yet, you'll pay a funding fee. But if later on the VA disability is approved, it's backdated, so they'll give you that money back. So you can recoup your funding fee if you get service-connected disability applied after, as long as you apply for it before you close. VA loans do not require any down payment, so I will not need any cash at all to purchase a home. Maybe. Trick question. So closing costs always exist. The question is, who pays the closing costs and how? Anytime banks say they've got no closing costs, they're not saying they have no closing costs. What they're saying is, we have closing costs, but we're going to raise your interest rate and we're going to pay them for you. You got to be really careful. So this is super in the weeds if we let it. So I don't want to go too heavy into this, but you have to account for closing costs. There are true non-recurring closing costs like escrow, title, notary, attorney, that kind of thing. And then there are actual prepaid expenses like taxes and interest and insurance that you have to prepay. They are there. And I'm really hesitant even to give you amounts. In California, I generally guesstimate if you're buying in the 500,000 range, it's probably around 2% for everything, like around 10 grand. It depends wildly on where you're buying, what time of year you're buying, who the seller is, all sorts of stuff. So you have to be really careful, but you want to anticipate. And again, I'm going to bang my planning drum and say, that's why you want to get a plan together and understand what that looks like. The thing about closing costs is you can pay them different ways. You can pay them out of your assets. Let's say you got 10 grand laying around and you're like, hey, I really want this house. I'm gonna put an offer in and pay this. The lender can pay your closing costs. But again, when the lender pays your closing costs, what they're really doing is they're raising your interest rate and then they're paying your closing costs out of their rebate. So let's say you qualify for a 2.75%. They may raise your rate to 3.25% and pay 0.1% of your fees. That's fine. But if you're staying in the property for a long time, your payment's going up, call it what, 50, 75 bucks a month. Over time, that's going to accumulate. You're going to pay a lot more in interest than you would have just paid in the cost. So you don't necessarily want to do that if it's a long-term purchase. The last option, which is a good option for a lot of people, is you can negotiate that the seller pays the closing costs. So the seller can pay the closing costs. You want to get a really good agent and get a really good agent who's good at negotiating, because the seller can pay the closing costs as part of that negotiation. So let's say you offer $500,000 on a house and the closing costs are $10,000. You can say, hey, in the negotiation, hey seller, I'm going to offer you $500,000 with $10,000 closing costs paid by you for me. And the seller can say, no way, Jose, I'm not accepting that offer. I'll give you the house for $500,000, but I'm not paying any of your closing costs. You could say, okay, well, look, I don't want to drop 10 grand right now. I want to keep that in reserves for, fixing the house up. So I'll offer you 510 with 10,000 closing costs. That nets you the same 500. That's how you can kind of roll it into the transaction. You can't roll it into the loan once you've landed on a purchase price, but what you can do is you can roll it into the purchase price and have the seller pay it. Again, it just takes a really good agent to kind of explain that, because sometimes people don't get it for whatever reason. All right, so that's all I'm going to say about closing costs. Again, plan. Last. And then I'll let you get to whatever you're getting to. The purchase process. This is going to be really brief. Because until you get into escrow, once you get into escrow, it kind of like you start working through it anyways, but I want to give you like a 50,000 foot flyover view of the purchase process. So here we go. First things first, you get pre-approved for your loan, meaning you put your plan together. You send your documents in. Some of you may have been pre-approved in the past where you just got your credit pulled. That's called a pre-qual, and it's not worth the paper it's written on. You want to send your docs in, send your LES in, send your tax returns, or whatever you need to send in, get it on file, and make sure it's all vetted, because then you get actually pre-approved. That pre-approval is based more in reality, and agents are going to take it more seriously. We in our office actually go a step further and actually get it underwritten and approved by the bank, just to take a step out, and just because we have the bandwidth to do it. And it makes people more competitive. So you want to go further than just a credit pull, but you get your loan situated. Let's call it that. Your realtor shows you homes that fit your criteria. So you're like, look, we want a house with a pool. We want 3 bedrooms, 2 baths. I want a garage. She wants a nice huge bathroom. I want a, satellite dish and I don't know, whatever. I was trying to come up with something clever, but my mind went blank late Friday. Whatever your criteria is, your realtor is going to show you some homes in that criteria. And then you're going to say, okay, well, we've seen all these houses. We really like the place on 123 Main Street. Let's get to business. The realtor helps you make offers. What's an offer? All right, I'll fix that after. The realtor helps you make offers and negotiates terms. So you offer on the house and negotiate back and forth. That's kind of the negotiating process. You kind of write a contract up and say, I'm going to buy your house for X, close in this amount of time. Here are the terms. Leave me your washer and dryer. You pay my closing costs. Here's my offer for your house. Should you start by finding the home or by getting pre-approved? I mean, clearly you should probably, I've been hammering on planning. If anybody said find the house first, I will reach through the computer somehow and do nothing. Who pays for the buyer's realtor? So this is an important question. The buyer's realtor is paid by the seller. So when you go in and you buy a house, you have a buyer's agent representing. Let me say it like this. I'm the seller. I'm selling my house. What I'm going to do is I'm going to negotiate with my agent who's selling the house. And I'm going to say, okay, I'm setting aside 5% commission, 2.5% for you and 2.5% to the agent who brings me a buyer. So your realtor is not paid by you. So get a good realtor, get your own realtor. Don't use the listing agent. It's their job to get as much for that house as possible and take care of their seller. Get a good realtor and you don't even have to pay for it. The seller pays for your realtor. Okay. Once you've negotiated terms, the contract is accepted at some point. At some point you come to terms. Okay, no, you can't have my this. Yes, you can. Okay, we're done. Contract is accepted. And then you do what's called opening escrow. Opening escrow is basically a term for starting the transaction. The transactions is called, at least in Southern California, it's called escrow, opening escrow. What we would do on the lending side is we would begin the loan process. So we would send your stuff in, update documents, get all that stuff out, disclosures, show you what your rates are, lock the loan, order appraisal. And then the realtor is going to take you through the property and you're going to start doing inspections. You got to do due diligence. You do a home inspection. So I said opening escrow. What is an escrow company? Some states use closing attorneys, but what's an escrow company? An escrow company is a neutral third party. If I'm going to pay X $1,000 in a deposit to show I'm serious, I'm not giving that straight over to the seller and hoping he gives it back if I don't own the house, if I don't buy the house. An escrow is a neutral third party that sits kind of in the middle, and you give your money to them and they only release it when you say to. You instruct them. You say, hey, when the seller gives me my keys, you can release these funds. The lender uses escrow. Everybody kind of uses escrow as this midpoint. It's kind of the center of the hub of the transaction. And they basically take instructions and give out money and pay off loans and do all that stuff. They're kind of sitting in the middle doing the audit of everything and making sure the numbers are all correct and all that stuff. So that's an escrow company. What's the difference between a home inspection and appraisal inspection? You guys probably understand this. Appraisal inspection is mainly from the lender. The lender requires an appraisal inspection that tells them that what the house is worth value-wise. They look at comparable sales in the area. They say, okay, this house is worth X. They're also going to kind of generally check to make sure that the house isn't falling over. There's nothing unsafe. VA, the house doesn't have to be perfect with VA, but you can't have like chipped lead paint falling at your toddler's feet. You can't have like a railing of a stairwell that's about to fall over and you're going to do a stunt man into the lower deck of your house. You can't have unsafe stuff. They'll make sure that there's a carbon monoxide detector and smoke detectors and that kind of thing, but they're not going to crawl under the house and check all that stuff. That's what a home inspection is for. A home inspection doesn't really have anything to do with the loan. That's what you guys order to protect yourselves. So you want to do a home inspection so that the home inspector is going to go and look at water pressure, look at temperature, look at any kind of they're going to go in the attic and the closets and check the drywall, check the outside, they're going to check everything and scare the living heck out of you. Put it all on a list. And then, and again, so you know what you're buying. And then if there's something that you really need fixed, let's say there's something that you just really need fixed. what you can do is you can go back with your agent and request that the seller pay for it, or you can do what's in, it's called a request for repairs, or you can say, hey, in lieu of fixing this, just give me $500 off my closing costs. So you can renegotiate and say, hey, I will keep buying your house, but you need to give me $500 because I need to replace this water heater, or whatever the situation is. Alrighty. Final stretch. So at some point, the loan's going to be approved, and then you're going to sit down with an actual notary, put your thumbprint down and your John Hancock, and you're going to sign about 50 million documents. That's going to kind of be the almost final point of the loan. Before you close, you and your realtor are going to walk through the house for a final time. You're just going to double check, because what happens if you looked at the house originally and it was furnished, and then when you do your final walkthrough, there's like holes in the drywall or something like that, or the mover screwed something up, or the carpet's disgusting, or you still have some way of saying, hey, look, guys, you guys need to fix this or clean this, or whatever the situation is. So that's the final walkthrough. We had a hilarious situation recently where they did the final walkthrough, and apparently when they went into their master bedroom, the wall had a massive purple like square on the wall. And so apparently they had painted white around the headboard, and the headboard was hiding this like hideous violet paint that was somehow there before. Anyway, so a final walkthrough will help you like make sure that the house is in good shape for you to walk into. Then the loan funds, and the escrow clears everything, and the title releases the loan to record at the county, and that's when it becomes legal. And once the loan records at the county, cha-cha, that's when you get your keys, and that's when you can kind of move in. So that's a real brief run through of the purchase process. So to kind of back it up and finish this all up, I just want to recap real quick. So Home Loans 101, understanding the basics. Remember, we talked about credit, income, assets. We talked about debt to income, loan to value. Then we talked about the VA home loan. It's not done by the VA. It's done by banks. The banks get a guarantee from VA. We talked about some of the benefits of VA: lower rates, more flexibility in most cases. Then we use the sample. We use the married sergeant with BH with dependents. Ran that sample scenario. Again, any of the stuff that you have questions about, just hit me up on the contact, or I'll give you my email address here in a second. And you could just ask me anything you guys need, but the sample scenario, hopefully that was helpful. Plug in your information and kind of run through the math, and you should get pretty close. VA loan, frequently asked questions. You can buy a multi-unit, has to be primary residence. You can have more than one. And then, as you'll remember from 2 minutes ago, the VA purchase process, kind of from pre-approval all the way through to closing. So hopefully that's helpful. Hopefully that gives you something. I'd love to have you guys out at, one of our live events, or I'd love to like sit down with you guys, or if you guys want to talk through anything you have going on or any questions you have specifically, we're here to help in any way we can. Remember, step 1, arm yourself with information. That's kind of like what we just went through. You've got a lot of good information. If you email me or if you message me, I'll send you a copy of the book, the VA Home Loan Field Manual too. So it kind of, same deal. Just email me and I'll shoot you a copy of it for free. Step 2 would be developing a personalized plan for yourselves. So again, I would say like, look, once you get off this, just jump onto that contact page and just say, hey, we want to just kind of talk through our scenario. And the beginning of it is just kind of a talking through of goals and what you're looking to do. And if it makes sense for you to do something with us, we'll do it. If it doesn't, we won't, but we'll point you in the right direction with really good info. And then it's just when it's time to execute the plan, go for it. It's all you. So you'll be all set. You can just you can buy when you're ready on your terms, but in a way that reflects a game plan that you're very bought into, because it's just been the plan the whole time. That tis it. That's my email address down there, daniel@leemangroup.com. If you want the slides, I can send you these slides. Just email me if you want or email me or message me on the site if you want a copy of the book, or if you want a copy of the vocab list or any of the stuff that we can provide you. Send it on over. And if you need anything at all, we're here. And thank you guys for tuning in, and talk to you soon. So that's it, folks. If you have any questions, always reach out. Just drop me a line. Reach out through the contact form on the site. Yeah, if you want me to email you anything or you need anything, again, whether we do something together or not, it's all good. I'm here to help in any way that I can. Thank you guys so much for taking the time again. It's late now, as you can see outside. It's dark, and my wife is going to kill me if I don't get home soon. So I'm going to let you get to it. Thank you guys again, and I'll talk to you soon. Here to help in any way that I can. Take care. See ya.